Hello, dear students. This is Dr. Madhuchanda Lahiri, Faculty P.N. Das College. Today I'll explain to you some basic concepts in national income accounting, some of the terms that are associated with national income accounting measurements, and also the different ways in which we can measure or calculate the national income for our country. So before we start, let me ask you one question. We all are very familiar with the terms national income of a country, or the gross domestic product, or GDP, the gross national product, or the GNP. Now, what do they mean? Wherein lies the difference between them? National income, as the term says it all, it is the total income that is earned by the nationals of a country. But this is a layman's definition. Before we proceed, we have to know the difference between two terms: the domestic territory of a country and the abroad, the concept of abroad, or what is the national frontier and what is the domestic territory of a country. The domestic territory of a country implies the physical boundaries of a country, and any area outside the physical boundaries of the country lies the or consists of the term abroad. Now, inside the domestic territory of a country, there are some people who may not belong to that particular country. The majority of the people lying within the domestic territory are, of course, the nationals, but there are some people who have come from other countries to work in that particular country. So these people are called as non-nationals. So that means the domestic territory of a country has a greater number of nationals and a lesser number of non-nationals living within its area. Similarly, the region that is beyond the domestic territory, that is the term abroad is used for those areas. It is the remaining part of the world. Therein also we find some of the people of our country have gone abroad for work purpose or for other purpose. They are staying there. So the abroad area also includes some people, a lesser number of people who are our nationals, and a much greater number of people who are not the nationals of a country. So in both the areas, whether it's the domestic territory or the abroad, there are nationals as well as non-nationals living there. Now, when we consider the domestic product of a country, we calculate, or we take into account only the people lying within the domestic territory of a country. Whether that person is a national or a non-national is immaterial. He may be a national, he may be a non-national. But the point is that the person should be staying within the domestic territory of the country. So, while calculating the GDP, or the gross domestic product, we consider the production or the goods and services that are produced within the domestic territory of a country by the nationals as well as the non-nationals, or the income earned by the nationals or the non-nationals living within the domestic territory of the country. Now, when we get the GDP measure for a country, it includes a part of the goods or services produced by the non-nationals of the country too. It includes a part of the income earned by the non-nationals of the country also. So the non-national element has to be removed. So that can be done, and also we have to take into account the nationals, those nationals who are living abroad. They were not included in the calculation of gross domestic product or any concept related to domestic product, whether it's gross or net. Uh, so the non-nationals living within the domestic territory, they have to be removed, and the nationals living in the abroad region, they have to be included to get uh, to get a perfect view of the contribution of the nationals of a country to its national income or the GDP. So what we do, we introduce a term called NFIA, net factor income from abroad. This is the difference between the income that is earned by the nationals living abroad minus the income that is earned by the non-nationals living within the domestic territory of the country. So this is a difference, and like any difference, it can be positive, negative, or zero. So positive value of NFIA means that the nationals of a country, they are earning more abroad, while the non-nationals living within the domestic territory of the country are earning less. And just the reverse happens when we have a negative NFIA, less than 0 NFIA. There it implies that the non-nationals living within the domestic territory of a country, they are earning more, while the nationals living abroad, they are earning less money for the country. And when the value is 0, NFIA is 0, it implies both the sets of people, they are earning exactly the same amount of money. Now when we move from the GDP or the domestic product concept to the corresponding national product concept, we add this NFIA element to GDP. So GDP plus NFIA gives us the GNP or the gross national product. So here the contribution of the nationals are taken only in consideration whether that national person is living within the domestic territory or abroad. He may be living within the country, he may be living abroad, but the point to consider is that he should be a national of the country. The non-national people who were considered in the domestic territory, they are no more taken into account. So this is the basic difference between the national product concepts and the domestic product concepts. And what is, of course, we have to consider of all these measures for one financial year, that is the year that is starting from 1st of April of a year and ends on the 31st of March of the next year. So this is the financial year, and any income that is earned by the nationals living in the domestic territory of the country as well as abroad, it is called the national income. Now these measures, they can be measured in terms of the market price of the commodities as well as the factor costs of the commodities. A market price is again the cost of production of the commodity plus the term called net indirect tax. What is net indirect tax? It is the difference between indirect tax and subsidy. So when we have net, when we have the indirect tax more than the subsidy, NIT is positive, and when the subsidy element is more than the indirect tax, we have a negative NIT. So, if GNP is calculated in terms of market price, we have to subtract NIT to get the corresponding GNP at the factor cost, because the factor cost values, they do not include the tax or the subsidy elements. Tax elements are not there, whereas the subsidy part is inputted into the calculation, so that they have to be taken into account in this way. So any movement from GNP MP to GNP FC, that is any concepts in terms calculated in terms of market price, if we want to find out the same concept in terms of market factor cost, we have to deduct net indirect tax. Now one more thing is there, the gross and the net concepts. Gross national product and net national product, GNP and NNP. Now how do we move from the gross to the net values for the same concept? This can be done by subtracting depreciation or capital consumption allowance. As we all know, the machineries which are being repeatedly used in the production process, they face a wear and tear, and these leads to a reduction in the values of the machinery, of the capital goods. So they have to be taken into account to consider the net increase in output. So we reduce the depreciation from the gross concepts to get the corresponding net concepts. For example, GNP to NNP, we subtract depreciation from GNP to get NNP. We subtract depreciation from GDP to get NDP. We subtract we subtract depreciation from GNP MP to get NNP MP. So there are numerous combinations that can be possible, but we have to understand the movement, or how to go from one concept to another. What are the things that are taken in consideration while defining a particular term, and what are those things that have to be left out in defining the other ones. So we have to include some and reduce some, remove some, and in this way we can move from one term to another term in the national income accounting theory part. But we have to be very clear with our concepts. Now I think this part is pretty much clear. So now we move on to some of the uses that we have that we get if we use the national income statistics, because these values, whether we want to understand which country is better off in terms of financial well-being of its people, we are considering different countries, then we can measure their national income levels. That too depends upon different factors. We may consider national income, we may consider per capita national income, because population again is important. Just the physical just the total amount of national income or the income of a country is not sufficient to judge the well-being, physical well-being, I mean the financial well-being of a country, because a country may not have huge population, and so it may have less amount of national income, but in the end it may be better off than a country having a huge population and a large national income. So different comparisons of the countries amongst the countries is possible using these national income statistics, and we can from these per capita GNP we can guess about we can make a guess about the standard of living the people of that particular country they have. So again, it also has a very beneficial impact for the government, because it helps for their to plan their economic policies. It reflects the economic growth of a country. It helps whether to conclude whether a country has improved over time. We can compare the, for example, we can compare the GNP of India in the 1960s to the GNP of India in the 1990s and in 2020, and say whether the country has indeed made an improvement over time or not. However, there are also certain limitations of national income accounting procedure, because here production or income is taken as the sole measure of the well-being of a country or its people. But the fact is that there may be uh, the leisure that the people enjoy, the off time, the welfare activities that the government does. So all these things, they also lead to the improvement in the living standards of the people of a country. But these are not taken into account while calculating the national income accounts. So if it is assumed in this theory that the more the production, the more the income a country earns or country produces, it is better off. So this has been the problem of national income accounting. Another thing that is very grossly tackled in this, grossly inadequately tackled in the national income account statistics, is that the non-marketed or unreported transactions are huge in case of underdeveloped country or a developing country. This thing we face in our country, in India, in a large part of Asia or Africa, but it may not be so important in the economies of the developed countries. But these transactions do occur, production is taking place, but maybe for self-consumption they are not brought over to the market. The person is living in his own house, owner-occupied houses. The person is giving his own labor. The person is using his own land. So these things, these factors are not coming to the market and brought over. So these things are not accounted for in a developing country's economy, and they are not included in the calculation of NI. So we may get a very lower amount of NI. though it could have been higher if these were taken into consideration. Again, then there is undesirable side effects of production, that is the air pollution or traffic congestion. That these are the diseconomies or negative external. These produce the negative external effect on the entire economy. But these their values are not included in calculating the national income account. So there are certain merits of having national income accounting for a country, done for a country, but again there are certain limitations, and we must very well keep these limitations in mind while taking a final judgment of what the entire thing is portraying. Before making our final conclusion, we must keep both the merits and the demerits, the limitations of the entire process. Now I move over to another section, the measurement of national income. It has got three distinct approaches: the income approach, the output approach, and the expenditure approach. These are the three methods of measuring national income in our country. So I keep it till here. I'll continue with the second part of the lecture next day, with beginning with the income method of calculating the national income accounting.